The World Economic Forum in Davos, Switzerland just got done last week. The glitz and glamour of this prestigious event was as usual, for everyone to see. Even though the underlying theme this year was rather grim. COVID and the Ukraine war have already exposed a weak global economic crisis. And for the first time since 1970s, inflation is moving up while growth is moving downwards. They usually move in the same direction. No wonder then words like stagflation, which I call the evil cousin of inflation, is making a comeback. Rising food and energy prices world over are causing havoc. The rich are becoming richer and the poor poorer. The latest report by Oxfam pointed that situation out in India as well. So amid all these economic troubles, probably India's most beloved economist, Dr. Raghuram Rajan, on the sidelines of this year's World Economic Forum, had a warning for Indian banks. And considering he was our ex-RBI governor, we should probably take his word of caution pretty seriously. So stay tuned for today's video where I analyze what Dr. Rajan said and the possible implications on our banking system if we don't pay heed to his advice. And guys, if you enjoy such videos, please be sure to hit that like and subscribe button for more such financial content. Dr. Raghuram Rajan gave an interview to a media outlet on the sidelines of the World Economic Forum in which he touched upon a few topics like the pension scheme, export of services from India, core inflation still being persistently high, and he even clarified that Mr. Rahul Gandhi was indeed a smart man and not what people refer to him as, Pappu. But one statement really stuck out more than the rest because this was to do with banks. I give Mr. Rajan a lot of credit for his views on the economy, but if it's combined with banking, it really does pique my curiosity. Mr. Rajan cautioned Indian banks on their aggressive new bet on retail lending. You know, loans to individuals, personal loans, car loans, home loans, gold loans, etc. He warned of a potential risk in case of a down cycle and reminded us what happened in 2007, 8, 9 when we moved towards infrastructure loans. It played out well for a few years and after that it created a lot of problems. He even acknowledged that India has made some real progress and that some business houses have paid off a lot of their debt. But he went on to caution banks, saying that bad loans begin to emerge when lenders become complacent. And the major problem with banks across the world is that they always find new ways of getting into trouble. Let's look at what he really meant. See, since the last few years, Indian banks, whether they are private banks or public sector banks, have switched their focus to retail loans. And it's a case of once bitten, twice shy. The late 2000s and the early 2010s were a period of abundance. It was when the Congress-led UPA alliance was in full swing. Banks were lending money carelessly to big corporate groups in the hopes of growing fast. And a lot of these loans were for big infrastructure projects. But the worst part was, during that era, when loans went bad, instead of declaring them as an NPA and recognizing it as a loss, banks used to restructure the loan and give more money to cover it up. It actually worked for a few years. But this window dressing of loans eventually led to a huge buildup of bad loans or NPAs in the system. The cleanup of banks began from 2016 onwards. RBI first identified what was then known as the Dirty Dozen, which was basically a group of 12 massive companies saddled with debt. These 12 companies were the first batch to be tried under the new Insolvency and Bankruptcy Act of 2016. As you can see, most of them are from the steel, power and infrastructure sectors. Banks who lent them money finally had to take massive haircuts when these accounts were resolved or bought over by other companies, which resulted in big write-offs in the bank's books. So somewhere along the way, after being bitten so bad by these NPAs, banks decided to shift their focus towards giving retail loans. What happens with retail loans is that the bank knows exactly what it's being used for. They can do a better due diligence and monitoring considering how much credit rating systems have improved. And it's a safer bet considering the smaller size of such loans. So RBI recently came out with a report that said in recent years, banks are displaying a herding behavior in diverting from the industrial sector towards retail loans. They further went on to say this concentration of retail loans may become a source of systemic risk for banks. But they were quick to clarify that they, RBI, are well equipped to deal with a policy toolkit and handle any systemic risk that may arise. Systemic risk is basically when bigger banks change their policies and smaller banks take up after them and behave in a similar way to the market leaders, and as a result get exposed to common risks. So it looks like Mr. Raghuram Rajan too subscribes to this view and therefore warned of the possible consequences of such a rapid shift to retail loans. Of late, if you've been tracking the results of listed banks, you'd have noticed one thing: how proudly they declare they have shifted from corporate and industrial loans to retail loans. It's almost as if they wear it as a badge of honor. SBI in its latest Q2 results said that it had changed its business model and now has a ratio of 64:36 of its loan book geared towards retail loans as compared to corporate loans. HDFC Bank in its latest Q3 results said that the same ratio, which is very similar to SBI's, stood at 65:35. Mind you, there are other loans to be considered as well, such as agriculture loans, rural loans, etc. I'm just comparing the ratio of retail and corporate loans. ICICI Bank, on the other hand, is ahead of SBI and HDFC and has a total of 54% of loans towards retail loans. Now that's aggressive. Other big and small, private as well as public sector banks have caught on to this trend and have shifted their loan books to retail lending. Banking as a sector is a cyclical one. It tends to do well when the economy picks up, which is what exactly is happening now. Now, some of you might think there's rural distress, no jobs available, MSME sectors in trouble. So how is the economy picking up? All these are lagging indicators and they will pick up in the coming quarters. But overall, many high-frequency indicators have picked up, and slowly but surely, the government's focus on infrastructure spending over the years is beginning to bear fruit. It's now the turn of private investment to show its teeth. Let's see if the upcoming budget has anything in store for that. But I digress. Banks, like I said, have begun to turn around. Gross and net non-performing assets, or NPAs, have reduced big time. Fresh slippages into bad loans have declined as well. Their profitability has increased, and even public sector banks have outperformed the Nifty and Sensex, as you can see from the table. In fact, they have outperformed the most. Credit in the banking system is at a decade high, which means that people and businesses are borrowing more and more money and will spend this money, which will have a snowball effect on our economy in the coming quarters. After a period of about 5 or 6 years, we're finally seeing this uptick, and almost every analyst is bullish on the banking sector for the short to medium term. So, the time of abundance, in my opinion, is just around the corner again. But Mr. Raghuram Rajan's and RBI's opinion is one that holds more weight for management of these banks. And they have cautioned banks to not be complacent and get carried away and put all their eggs in the retail basket. At least not without some serious thought of what could go wrong in the future, just like the past. Thank you.